Lance Fritz. Lance, thanks for being with us.
Thanks for having me, Morgan. It's a pleasure.
So I realize that results were impacted by weather and also fuel in the last quarter. Homing in on your guidance and the fact that you also basically raised your volume guidance to the higher end of the range, 6% now. Walk us through what you anticipate this economic recovery from a rail standpoint to look like in the coming weeks, coming months.
Yeah, the reason why we strengthened our guidance to be at the high end of our range for both volume and margin improvement is that we're seeing the economy strengthen and strengthen pretty dramatically and pretty quickly. We've already seen good e-commerce, good consumption by consumers, but it's starting to be matched by some movement in the industrial economy. Housing and construction looks good. We would see, I think, good plastics and industrial chemicals, but for recovering from the winter weather event that hit Texas and Louisiana. And we're also very encouraged by continued strength in grain in some other markets. So we're just starting to see it broaden across our book.
Yeah, pricing, it looks like pricing that exceeds inflation is what you talked about, at least in the release. And this, of course, on the heels of last week, Union Pacific raising the surcharge on excess contract cargo, the first time that we've seen those peak season fees actually instituted before summer. Talk us through that.
Yeah, those peak season charges are all about domestic intermodal and making sure that we have the capacity to serve customers that are in our MCP program, which is a program where we guarantee them a certain amount of capacity if they guarantee us a certain amount of rateable loads through the year. And with demand very, very strong right now, we just need to make sure that boxes are available for those MCP committed customers. And that's exactly why we raised those surcharges. It's a very strong market for domestic intermodal.
Yeah, just to shift gears a little bit and look at the industry more broadly, we were talking about it just a few moments ago, but the fact that, and I think many folks maybe didn't anticipate that we would be at this point again, but the fact that we're now having this bidding war essentially between Canadian Pacific and Canadian National for Kansas City Southern, what could potentially be this new wave of rail consolidation. How do you see it? And if we see a deal actually move forward, what does that mean for your longer term strategy?
Yeah, so let's talk briefly about the process. So they have to put an application in for the merger to be approved, whether it's the CNKCS or CPKCS, to the Surface Transportation Board. That's our commercial regulator, the STB. The STB, in their own words, have said that the next Class 1 merger is going to have to be evaluated for its impact on enhancing competition, being better for customers, and also its downstream impact on further consolidation in the industry. The STB has sole authority on figuring out the regulation environment and the remedies to make that happen.
Shepard Smith here. Thanks for watching CNBC on YouTube.